Okay.
There you are.
Okay, I will get us started. More people may join. So thanks to everyone for joining the first seminar in the tax policy speaker series at the Adler School of Law at UBC today. This series is organized as a part of a course on tax policy offered to our JD and LM students this term. But it's open to the public, and I'm very pleased to welcome those of you joining us today from outside the Adler Law community. We're very grateful to have Ruud de Mooy with us today for a presentation. Mr. de Mooy is an advisor in the International Monetary Fund's Fiscal Affairs Department, where he previously headed the tax policy division. Before joining the International Monetary Fund, he was a professor of public economics at Erasmus University in Rotterdam. As a scholar, Ruud produced extensive, important, and innovative work, including in top journals like the American Economic Review and the Journal of Public Economics. But more importantly, especially for legal scholars like myself, and of course for the policy community and the public, Ruud has led a powerful team of economists at the IMF to produce very high quality policy analysis that inform current policy debates. We're very, very happy that you can make time to talk to us about this important topic, which is tax policy for inclusive growth after the pandemic. So our plan today is for Ruud to give a presentation for up to 40 minutes. I think maybe we can take occasional clarificatory questions if there are such questions, and then we will leave at least 40 minutes for Q&A where audience members can directly engage in conversation with Ruud. If you have clarificatory questions while Ruud makes the presentation, I suggest that you submit the question through the chat box, and I will monitor the chat box. And I also would like to ask audience members to put themselves on mute when not speaking, which all of you seem to be doing already, which is great. So with that, Ruud, I would love to hear your talk. Thank you.
Thank you so much, Wei, and welcome everyone. Can you hear me well, Wei?
Yes.
Okay, very good. So it's a pleasure to be among you. I cannot say with you because of the extraordinary circumstances you're in, but it's a pleasure to participate in this series. And for me, it's a great opportunity to talk again with students because I've always very much enjoyed that when teaching at the university in the Netherlands. It always pushes me harder to think and to be more clear in terms of what I mean. So I'm very much looking forward to the exchange with all of you. So today I'm going to talk about this note that we did entitled Tax Policy and Inclusive Growth After the Pandemic. I'm going to make this a little smaller. But before doing that, maybe I'll briefly talk about two other things, which maybe many of you are not so familiar with, which is the role. I'm trying to get to the next slide, but there we are. One is sort of the role of the IMF in the tax debate. What does the IMF do in terms of tax? Which is the capacity development and also analytical work that I just referred to. So I'm going to say a little bit about sort of the type of work that we do, very briefly, but so that you have sort of a bit of a context in which this note was written. And also illustrating the interplay that takes place at the IMF between sort of the more analytical work and the in-country advice that we give. And this is always sort of an important aspect of our business model, that we have these both legs of sort of tax analysis and tax advice that we give. Then I'm also going to say a little bit about the COVID context, and that's the context in which this note has been written. So that you have an idea of where this fits into the sort of the ongoing policy debate that is also taking place within the funds. So that's first of all the initial COVID responses, but then the note is more about sort of future tax policies in light of COVID. The picture that you see here is how the IMF these days look like during the meetings. This was taken during the annual meetings. There was one participant who thought the meetings were not virtual, apparently. But this is how Washington looks like during these days where there's normally thousands of people visiting DC. On the tax work that we do at the fund. So this basically lists here on the left the capacity development work, the type of work that is taking place when we go to countries and help countries. This is an important task of the IMF. The IMF has three major tasks. One is sort of lending to countries that need liquidity. The second is surveillance of their macroeconomic policies and the macroeconomic situation. And the third is capacity development in various areas. So we are talking about capacity development. And that is mainly taking place by what we call missions. So in normal times, we go to countries, talk to the authorities, to the minister usually, on what he wants from the IMF to have advice, what type of analysis that he would like to have support on. And then we visit the country, we talk to people, we collect information, we collect data sometimes, and then we, at the end of the mission, give him the answer to his questions. So that's typically things like diagnostic reviews, sometimes very specialized advice, but also increasingly support with implementation, including, for instance, legal drafting. But a lot of support with implementation is also related to building capacity at tax administrations to implement the policies that we advise. It also includes what we these days call medium-term revenue strategies. This is the big picture of how revenue policy fits into the larger strategy of the government, especially for development. Because most of the work that we do is in developing countries where capacity is typically lower than in advanced economies. And there's a whole range of other activities that we do to support these activities, including workshops. We have various publications to share our knowledge. We also do research. So that's the whole range of sort of supporting work for the capacity development. And on the right, you see how we are organized. So it's really quite a large team at headquarters. We are about 80 people in the tax area. That's policy and administration. And then we also have some people in the legal departments. But we also have people on the ground in countries. So in the regional centers, there are the people that help with the implementation of our support. When it comes to sort of building up the tax administration and teaching sort of practices in the tax administration, then we rely on people who are actually in the countries themselves. Either in one of our regional centers, there's 10 regional centers from the IMF, but also sometimes people put in the Ministry of Finance or in the tax administration to help them implement the advice. So the other angle is sort of, this was the country work, which is how we call it. The other angle is analytical work, and that's really sort of defining our business model, that we have the country work where we learn a lot about how countries are operating, how it functions. We can use that information to share with the rest of the world sometimes to distill best practices. So that is reflected in our analytical work. But it's also the other way around, that we do analytical work, we do, let's say, data analysis, we follow what's going on in the literature. So we work a lot together with scholars like we meet each other often at conferences, because we want to make sure that all our advice is based on the most recent and the best available knowledge in the profession. So here we participate basically in the frontier of the profession in public finance and in tax analysis. So here's some examples of publications. Part of it is more research oriented. Others are more also sort of tools that we develop to standardize some of the advice that we give. So for instance, here there's an example of tax expenditure reporting. So we have some kind of framework for how to do that in countries. And the other example here is what we call the tax policy assessment framework, which is still being developed, but we have some modules already online that help us and also help country officials in sort of deciding on certain aspects of policy. So then maybe move to the COVID context. So the note that we're going to discuss today fits into sort of the discussion that we're having in light of COVID. And what we typically do, and many others have done, is divide the COVID tax response in three different phases. So there was the immediate sort of response that when the COVID hit and the lockdowns were imposed, there was immediate policy responses in various aspects, including on the spending side, but also on the tax side. And these measures were primarily focused on things like supporting health, but also ensuring business continuity. The businesses that were locked down were immediately in liquidity problems, so governments immediately stepped in to support business continuity by delaying tax payments and so on, and changing installment payments, but also some policy measures like loss carry backwards and so on. And the third was more sort of related to protecting people, to immediately provide support to people. So there was immediate response on the tax side to support sort of all these aspects of life when the pandemic hit. And basically, we haven't really sort of gone out of that situation. We are still in many places in lockdowns, and the support that was provided has been extended in many countries for that reason. And so whether we are already in phase two and when we are in phase two is not always easy to define. But typically, phase two is seen as sort of a phase when there is a reopening of the economy, and when the economy still needs some support from the government to basically recover from the shock. And so people talk about this phase as a stimulus phase, because the government still needs to sort of support, but it's a different type of support than in phase one. And this is not an easy phase to define, and how to define the right policies, because we can, what we normally, if we have a recession and we think of fiscal stimulus, we think of having a temporary cut in the VAT rate, or having accelerated depreciation for investments to bring, and temporary to bring all this forward, to have the economy sort of start again. But in this case, it's more difficult to define what is the right way of doing fiscal stimulus. So when you phase out the support that you've given in the first phase, and you move to some different type of support. So what is, in terms of timing, what is the right timing to shift the support that we're giving? Are we stop giving support to the firms that are hit hard by the crisis? Or do we continue with that? And that's not an easy choice, because some of these this support might be to firms that may have not have a good future after the pandemic. So that's a difficult sort of design issue. And the same holds for the targeting. What is the right way of targeting the support? And normally we say, well, this temporary VAT, or we focus on the low-income households. But what is the right targeting in the stimulus phase now? And also, what is temporary? That's because we always talk about the 3 T's of fiscal stimulus. The third T is it should be temporary. But when should we stop giving this support? And so that's also a difficult question. And the overarching view now is that we're certainly not there to stop the stimulus, to withdraw that and leave the private sector on its own. It's most economies and also the IMF says, well, the cost of doing that, of too early withdrawal of the stimulus, could be very, very high. So this is not the time to do that. But when is the time is not entirely clear. But once it comes, we get to the sort of consolidation phase. Once the initial recovery has taken place, the time comes for governments to pay back what they have borrowed, and also to restore sometimes the reduced revenue that is sort of occurring right now. So this is the phase that we're going to talk about today, the recovery phase. What kind of policies can we sort of think of once the pandemic is really over? And here's a picture I took from the Fiscal Monitor that was published last week for 3 groups of countries, the amount of support that they have given, just to give you an idea of how big the interventions have been by governments. And this is important because governments have to pay back these debts. And what you see here is for 3 groups of countries. So AEs is advanced economies, MEs is the emerging markets, middle income economies, and the LICs is the low income developing countries. And you see how much they have engaged in spending. So these are the most on top. And at the bottom, you see what has happened to revenues. And so even in revenues, you see for the advanced economies, a drop in 3% of GDP. A huge, huge decline in the emerging markets. It's even 4% of GDP. And in low-income countries, it's a bit less because they've taken fewer discretionary measures because they basically have no room to do that. But these are significant changes. And overall, the world has increased spending and reductions in revenue of 14 trillion. Which includes then also some of these things like guarantees and equity injections and so on. But 14 trillion is 10% of GDP. That is really unheard of. And what we see is therefore that public debts have risen to record high levels. It's close to 100% of GDP globally. But in advanced economies, it's more than 123% of GDP these days. And you also see that in deficits in 2013 have the average deficit was 13.3% of GDP in advanced economies. So enormous shocks in terms of debt for governments, which sort of set the stage for what we can expect going forward. So we expect, for instance, on the tax side at the fund that there will be a lot of work ahead of us. Now on this phase 3, higher taxes likely needed, maybe also emphasize that these days, although the debts are very high, the thinking about high public debt is different than it has been in the past. And that is because the interest rates are so low. So interest rates are lower than the growth rate. So even if we sort of have a high debt, and we pay our interest, which is very small interest, but the growth of the economy is higher, than the debt to GDP ratio will automatically decline going forward. The question is, of course, how long this will remain, and some people are more concerned than others. But at this point, the sort of focus on public debt, which has been sort of very prominent in recent crises, is less prominent than then because of the low interest rates. So that's also why there's a lot of focus on the view that we should not withdraw the support too soon. It's better to stimulate and to build more debt, even as the debt is already very high, but the interest rates, the interest payments that are associated with it can still be serviced because of the low interest rates. Now, some people are optimistic that sort of growth will outpace interest rates for a long time. Others are less optimistic. So, but the overall view is that taxes at some point will have to play a role in the phase of consolidation, in the sort of after the initial recovery. And that's why we wrote this note, on which you see a copy here on the right, on tax policy for inclusive growth after the pandemic. So that's what we're going to talk about today. So a little bit more sort of context on what we mean by this before we get into the sort of the various taxes and how we think about those. First of all, what do we mean by inclusive growth? Well, the preference for economists and for tax people is probably to talk about the criteria of a good tax system. So you want the tax to be equitable, you want it to be efficient, and you want it to be enforceable, simple. So the typical criteria for a good tax. And inclusive basically refers to equity, efficiency to growth. And so this is more sort of the today's way of framing the discussion, to emphasize that this is not just about economic growth, but it's really also about equity aspects, something that we're quite familiar with in the tax area. The other criterion of enforceability, of simplicity, let's say, of course, is very important for inclusiveness and growth. And it's basically, for many developing countries, a condition for any tax, because if you can't enforce a tax, it cannot be inclusive or growth friendly anyway. So this is really a precondition that often defines the policies that are feasible. Now, on inclusiveness and sort of equity, of course, this is about progressive taxes. So we're going to discuss a lot about the progressivity of the income tax, of the tax system. But inclusiveness also refers to other dimensions of equity, like gender equity receives a lot of attention these days, generational equity, equality of opportunity. So it's broader than just progressivity and the vertical equity aspects that we normally emphasize. And what is also important, and we stressed it in the note, is that we have to take good consideration of the issue of tax incidence. If you change the tax, how prices change and how it ultimately affects people and which people. And this is often ignored in policy discussions and also in policy analysis even, but is important in sort of interpreting what is a good tax reform when it needs to be inclusive and growth friendly. When it comes to growth, of course, this is about sort of efficiency, so about tax distortions in all kinds of ways, a few listed here. But efficiency is also about other components of welfare. It's not just about economic growth. It's also about things like the corrective role of tax in light of the environment or in light of health. So we also pay attention to these aspects of sort of efficiency, which are broader than just looking at economic growth. Then maybe briefly the other way around. So we've talked about sort of inclusiveness and how it can be interpreted in the tax context, but how does taxation matter for inclusive growth? And it matters in various dimensions. So it matters in terms of the tax level, the tax mix, the tax design, and the tax implementation. They all matter for inclusive growth ultimately. And so on the tax level, I think for advanced economies, the discussion is often very contentious because it's, so what is the optimal size of the tax level? What is the optimal size of government, basically? So you get into discussions on how big the government should be, and then that's a very contentious and political discussion. It's much less contentious for developing countries, though, because I think for developing countries, the general view is that many countries do not raise enough to fulfill the basic functions of the state that you really need, both to address equity issues, but also to grow. And there was a very nice study by Vitor Gaspar, who's my boss, with some co-authors a few years ago, where they estimate growth regressions, but they do not look at the impact of the size of the tax on growth, but they look at regression discontinuity. So at what point do you see that this relationship really changes? And they find this sort of what they call a tipping point. So if you are at a tax level that is below a certain level, economies just do not grow very fast. And if you go beyond that level, then you see that systematically that the growth rate is higher, and that's illustrated in this picture here on the right. And what they conclude is a safe level is sort of at around 15%. So if you're below that, it's very hard for economies to grow. So that's the tax level. What is also important, what we know, is the tax mix. So the mix, for instance, between direct and indirect. And there are all these growth studies that look at sort of how the tax mix influences growth, showing that direct taxes tend to be more distortive for growth than indirect taxes. But also, we know that direct taxes are better for addressing inequality than indirect taxes are. So there seems to be some kind of a trade-off between equity and efficiency. And I think what is important to note is that what matters a lot is not just the mix, but the design of each of these taxes. And for instance, a very poorly designed VAT can be much more distortive for growth than a very well-designed corporate income tax. And so today's focus is also very much on the tax design, on the various taxes, on the income tax, the VAT, and other taxes, which matters a lot for inclusiveness and for growth. What is also important is tax implementation. That's basically a binding constraint often for both the level, the mix, and the design of taxes. And that's, of course, you can go very deep into the issues of tax administration, but we're not going to do that today, and also not in the notes, although we do take into account some of these constraints when thinking about tax design, in particular for developing countries. So having said that, this is then sort of what the note does. The note is a very short note, as you've seen. So we write these notes, the COVID series, we call it. They are supposed to be less than 10 pages because that's sort of the time spent for many policymakers and also people in the IMF. They can read 10 pages very quickly, so we were forced to write it in less than 10 pages, which is an immensely difficult task because this is basically about everything about tax. So what we did in the note is having a lot of references to more in-depth analysis that we've done at the fund. But it is important also to get a full picture of sort of the options for governments to think of their progressive options for progressive taxation after the pandemic. So you want to have a sort of a good overview of the various options. So that's what I'm also trying to do today, based on the notes. And it's also sort of a starting point for a discussion. And let's see where you want to discuss further, and then you determine the agenda going forward. Because we probably cannot go into much depth in each of these topics, but just touch upon some of these issues right now, and then see how we can take it forward. So these are the four that we're going to focus on now. So let's start with the when we talk about progressive taxes, the most important one, which is the personal income tax, because the personal income tax can be individualized. So the government knows what is the personal income of each individual, so it can use that information to design the scheme in a progressive manner, namely with a tax burden that rises with the income of people. And that's basically our framework for thinking about these issues is very much inspired by basically tax theory. So the famous Merle's article from 1971 is about finding the optimal balance between equity and efficiency by designing your tax benefit system. So how do we do that? That is the conceptual problem that is defined, and that is also informing, I think, the discussions. And it's very striking that many countries have personal income tax systems that follow the prescriptions of these optimal tax models. And there's a lot of logic sort of in these conceptual frameworks. So basically, that's also the logic that we follow in our advice. So in terms of sort of defining the tax base, the tax rates, and here are some of these features that we typically advise to countries. A reasonable threshold is common and also desirable. And what is following from these optimal tax models is basically that you combine that also with transfers. So it's kind of a sort of a negative income tax, but most countries do not have really a negative income tax. They organize the spending side, the transfers, in a different way, as a sort of a separate from the tax system. But it's basically the same idea. But you also want a reasonable thresholds, which differ quite a lot between advanced economies and low-income countries, as you see here also in this picture. So in the OECD countries, I guess the average sort of threshold below which you don't pay personal income tax is about a quarter of the average wage. But in low-income countries, it's typically more than the average wage that is exempt, because they miss sort of this large middle income groups that typically pay tax in advanced economies, but they're just absent in many developing countries. And so the majority of the population in developing countries is not subject to personal income tax, because incomes are simply so low that it falls below any sort of subsistence level. There are some other features that you can think of in terms of deductions, in terms of income relief for instance, earned income tax credits. I won't discuss that in greater detail now, but that is sort of also reflected in these optimal tax schemes. And this is also what we can advise, but more for countries that have better administrative capacity, because these are sort of more difficult to properly administer. When it comes to the rate structure, maybe it's also interesting. From these models, what you find is that the rate structure is not typically flat. Rather, you would like to impose higher marginal tax rates on higher incomes to support your redistributive objectives. So a flat tax that some countries have, and there are these days about 27 countries, I counted recently, that have a flat personal income tax. So they have this threshold, but then they have only one rate. They are typically not optimal. And I have a picture on the next slide. This is from a paper by Emmanuel Saez, who was the first to sort of, in a very intuitive way, present the results on the optimal marginal tax schedule, that it typically follows this U-shaped pattern. And this is for the tax benefit system. So what you basically do is at the bottom, people with very low incomes, you give a transfer for redistributive purposes. But then you do not want to give this transfer to everyone. So you phase out the transfer with income, which creates this high marginal tax rate at the bottom. That's why the marginal tax at the very left is very high. And then after you've phased out these transfers, you only have the income tax. So that's for the middle income group, where you see at the bottom of this U-shape. So these people face relatively low marginal tax rates. And that's because there's huge amounts of people in these middle income groups. That is where the density is the highest. And you don't want to distort their behavior too much, because that would sort of create large distortions. But then for the higher incomes, you do want to have higher tax rates for redistributive purposes, just to increase the progression of the system. And that's also because there are fewer people there, so the distortions are in aggregate terms not as large. So the optimal tax is typically not following a flat tax, and that's also consistent with what most countries have. They don't have a flat tax. They have linearly increasing marginal tax rates. And this also raises the question, sort of, where should these tax rates end? So what is sort of the best optimal or the optimal top personal income tax rate? And this is, again, a very contentious issue, where, again, these models do give us some guidance. Namely, suppose you would not care at all about the welfare of the people at the very top. So you have some kind of Rawlsian social welfare. then what you want to do is you want to raise as much revenue as possible from these rich people. So basically, the extra, if you increase the tax rate, you have extra revenue over the given base, but you also have a change in the tax base because they start to avoid or evade taxes, or they change their behavior in terms of labor supply, or so that's captured in this elasticity of taxable income. So you can this formula shows what is the rate that sort of yields the maximum amount of revenue, and it's a very simple formula. Depending on two parameters, it's this responsiveness of the tax base to changes in the tax rate, the elasticity of taxable income, and it's the parameter that determines how thick is the tail of the distribution. How many people are above the level where you start paying the top personal income tax rate. So this type of exercise is very difficult, very easy to do for various countries, and you can infer sort of an idea of what is the maximum amount of revenue that can be generated, and at what rate would that be. So the revenue maximizing top rate is illustrated here at the bottom. And so there was a study by Slemrod, Saez, and Geert in 2013 reviewing these elasticities of taxable income that said, well, it's the average is about 0.25. So that's for the elasticity, reflecting the responsiveness. So if you use that, and if you have, for instance, the A's here are these Pareto parameters. So the A of 1.5 applies to the US, because in the US there's quite a thick tail. There's a lot of people above the level of income when you start paying the top personal income tax. In that case, the revenue maximizing rate is 72%. There was also a study for the Netherlands where the tail is much thinner. There are much fewer people above that have very high income, so to say. So for them, the Pareto parameter was 4, and that gives rise to a revenue maximizing rate of 50%. So it is country specific, but it does provide us guidance on the top personal income tax. So I leave the issues about individualization and special regime for self-employed for now, and move to capital income tax, which is another important aspect of sort of inclusive tax policy for inclusive growth, taxing capital income. And this is something where economic theory is much more controversial than I think in the personal income tax on labor income. And so there's a very famous result by Chemley and Judd, which extends basically a result earlier obtained by Atkinson and Stiglitz, that the optimal tax on capital income is 0. So we should not tax capital income. Not for equity, not for efficiency. It's just distortive, and it's not equitable because capital income is basically postponed consumption, and you don't want to distort the choice between consumption today and the consumption tomorrow. So that's sort of the intuition behind these results. But these results have come under significant scrutiny and criticism within the economics profession. And I would say that the support for those views has been waning quite significantly, even recently with some important publications. And I think you also see that most countries do tax capital income, but there are also good economic reasons and equity reasons for that, especially because capital income is so highly skewed towards the top. And I'm showing here a table that I borrow from a recent article by Jane Gravel in the National Tax Journal on the US distributions of income. So for instance, what you see here on the left is the income percentile. So for instance, the second row at the bottom is showing then the 1% top income percentile. So these people have incomes above 500,000 US dollars. The average income is 1.6 million, you see here. And then you see how their income is distributed. So a bit more than a third is wage income. But another third almost is capital gains. And then about a quarter is business income from self-employed, so from small businesses. Now, if you move to sort of the 0.01% of the income distribution, so the very top, not the very top at you can also look at that, but let's look at the second row, for instance. Then you see that, for instance, wages is only 15%, and capital gains become more than half of the income. So capital income is very skewed towards the very top. And if you look at the very top line, it's even capital gains is more than 56% of the total income of that group, and wages is only less than 9% of their income. So capital income very skewed, important for thinking about inclusive tax policy. Now, how to tax capital income? There's, of course, a lot of discussion and a lot of systems around to choose from. I think the typical advice that we give to developing countries is to consider the classical system, which seems simpler than the integration system, where you give imputation credits to sort of the corporate tax already paid. And I think there's been sort of a shift also towards away from integration system towards these more sort of classical systems with a personal income tax rate that is lower than the top marginal tax rate on labor income. So modest personal income taxes. What is also important with respect to the tax base is, of course, to minimize exemptions, because an important criterion for taxing capital income is neutrality. And that also guides, I think, the discussion on tax rates. What rate should we apply to capital income? I guess the guiding principle is really neutrality, because if you do not tax them neutral, then of course you have all kinds of avoidance taking place. If you don't tax capital gains similarly to dividends, then there will be a shift away from dividends, away from payments as dividends towards realizations of capital gains, or the same with interest and equity. So you want to have it as neutral as possible. And also there's, of course, the issue of arbitrage between labor and capital income for the small corporations, the owner director of a firm who can pay himself labor income or capital income. So that's another sort of criterion that you want to take into account. So that's with respect to tax rates, as neutral as possible. And I think very important for capital income tax is also the enforcement. How do we enforce this tax, which has been, I think, in the past quite difficult for many countries. Advice that we often give is use withholding taxes where possible. If there's a payment of dividends, make sure to use the withholding tax immediately. Sometimes final, or if it's sort of an income tax, part of a global income tax, you can use it as a sort of withholding mechanism. Also, of course, there is the exchange of information now taking place internationally, which can be used for reducing tax evasion. People maybe in the past find it quite easy to evade taxes by hiding it abroad, but with the automatic exchange of information, the hope and expectation is that this is becoming increasingly difficult, and the enforcement of capital income taxes will improve. Maybe something then on taxing capital gains, which probably is the most difficult one among the taxes on capital income. I mean, dividends and interest, you can levy a tax on when the payment is made by a bank or a large company. But capital gains is typically more difficult, especially because taxing on accrual is very difficult. Then you have to have all kind of valuation issues. If there's no real payment, no real transaction, it's not always clear what is the precise value of the gain. So capital gains are typically only taxed upon realization. Also to address problems of liquidity. People might not have the cash to pay the tax if they have not realized the gain. And if you force them to realize the gain to pay the tax, this in itself would be a distortion. And so what you see in the real world is that almost all systems are based on capital gains upon realization. But this also raises its own problems. So for one is the lock-in effect, that you can defer your tax payment, and you see that many of these very rich people in the US, they don't realize their capital gains. Mark Zuckerberg, he basically has huge capital gains from the stock price of Facebook, but he does not realize these gains, and he doesn't have to pay the tax on it because it's only taxed upon realization. And in the US, there's, sorry?
I just want to briefly interject. We want to leave some time for question and answer. I suggest if you can use 5 or at most 10 more minutes,
Oh, okay.
that would be fantastic.
Yeah. So what I'll do is I'll focus on the taxation of wealth. I'm sort of done with the capital gains. I'm going to discuss wealth taxation and probably leave the other topics for if people want to raise them in the discussion. Yeah.
Fantastic. Great. Thank you.
So taxing wealth, because this is an important discussion also, and a very topical discussion. There's all these discussions in the US on wealth taxation, but also elsewhere. It's coming up a lot. There are fierce proponents, Thomas Piketty, Zuckman, Saez, are fierce supporters of taxation of wealth. It's also important to note that it's not taxation of wealth is, of course, broader than just net wealth taxes, which we do see in some countries. And the picture on the right is interesting in that respect. That's recurrent property taxes is the blue-colored bars on the revenue from real property taxes. They are much more important in terms of revenue than net wealth taxes, which are the red bars here. So there's only a few countries with the red bar. And the size is really small, so they don't raise a lot of revenue, except maybe for Switzerland. The yellows are here is taxes on financial transactions, like if you sell a property, you have to pay a transaction tax, raises quite a bit of revenue in some countries, but not so much the net wealth taxes. So property tax, I'm not going to discuss property tax for the sake of time, but is an important tax, also potentially for developing countries. Another is inheritance and gift taxes, which is another form of transaction tax, which, of course, are somewhat different. They also have some similarities with the net wealth tax, but are only taxed when a person passes away and the wealth is transferred to another person. Has more, I would say, support from economists and lawyers also, mainly because viewed from the person who receives it, can be quite fair to say, well, you're lucky to receive this inheritance, but the government shares part of that this transfer. But I'm going to focus now on the net wealth tax, because that is sort of the most prominent discussion taking place. Maybe some information about wealth taxes. So this table I borrowed from a paper that I think this week appeared in the Journal of Economic Perspectives by Joel Slamrod and co-author on the experiences of wealth taxes in various countries. And what you see basically is it illustrates the low revenue in many countries, but also why that is the case, because there's often exemptions of important components of wealth. Pension wealth, for instance, is typically exempt in countries. Same holds for the main residence. Often there's special provisions also for assets held in closely held businesses. So if you exempt all these major categories of wealth of people, then of course the base narrows enormously. But it's not just that, it's also that that this creates opportunities for avoidance. So you do not save through stocks, but you save in your pensions because that's exempt from this tax. So a lot of avoidance opportunities. Also, what you see from this table is that many countries repealed their wealth tax. So they had one for a while, but they repealed it, probably because the revenue was so low relative to the administrative costs. But also some countries reinstated the wealth tax, so that's interesting too. And as I said, the country that is often mentioned as the example with a successful wealth tax is Switzerland. Maybe more information. This is what I took from a paper by Piketty, Saez, and or this was a paper by Saez and Zookman, but I refer to one with Piketty on the shares of wealth. And I thought this was interesting. This is for the US, that how the total wealth is divided between different types of assets. And you see the large share, for instance, of housing assets. It's more than a third of the total assets is housing assets. Pensions is also about a third. So you see that if you exclude them from the wealth tax, then you already exclude 2/3 of the potential base. And what the authors say, Zookman and Saez, is these should be included in any net wealth tax. Well, then the question is this a good idea, a wealth tax? And then, of course, as economists, we want to know, well, what is the experience? What can we say about the how wealth taxes have performed? And also conceptually, how does it differ from a tax on capital income? Because in some sense, they target the same base. One targets the flow of income that is generated from the stock, and the other directly targets the stock of wealth. And if the return would be the same for every asset, then they are actually equivalent. So I would say that if you compare those two, then economists tend to favor the capital income tax over a wealth tax, because if you pay a wealth tax, you also pay it when you make a loss, for instance, whereas a capital income tax, you pay on the return. And so if you make very high returns, yeah, the government shares in that return, but if you make a loss, the government also shares in that, which is deemed to be more fair, but also more efficient because it encourages risk-taking by people. So economists tend to prefer the income tax over a wealth tax. But I think there's a lot of discussion these days, not for a wealth tax as a substitute for the income tax, but more as a complement. And that's what is called the progressive wealth tax that only targets the very rich. And that is also motivated by sort of the inability to tax, for instance, capital gains properly through the income tax. A lot of these capital gains go untaxed or get deferred so long. So maybe the progressive net wealth tax can then supplement the system to target this portion of the wealth, which otherwise basically largely goes untaxed. And also the belief is that liquidity issues that are important for sort of having capital gains tax on realization may matter also for the net wealth tax, but maybe less so for the ones that are very much at the top. So these are the proposals for a very progressive net wealth tax. Now, what do we know about wealth tax performance? We have already seen sort of this table from Slamrod that many countries repealed it. So it's important to think, why have they repealed it, and what can we learn from these experiments? So there is some information about behavioral effects, and studies have estimated this elasticity of reported wealth. So if you increase the wealth tax, how much is the reported wealth being reduced? Because either people avoid or evade it, or they change their behavior. They basically reduce their savings. And the elasticities found, for instance, for Switzerland, they're sometimes very large. So the Swiss one was more than 40%. So 1% point wealth tax reduces the reported wealth by 40%. That's enormous. So this comprises of evasion, avoidance, and behavioral responses, sort of in terms of savings. There are also studies that look at each of these channels separately. And for instance, on evasion, studies find that evasion is much more prominent among the very wealthy than it is sort of elsewhere in the wealth distribution. So people with normal wealth, they don't bother to bring their wealth to some offshore location. But apparently the very wealthy, these elasticities are found to be much, much larger. So if you do this progressive wealth tax, what will actually be the impact is very hard to predict. And so this paper I referred to by Slamrod said, well, when evaluating a US wealth tax, one can best hold its breath. basically indicating that we have very little evidence to build on to assess the precise revenue impact. And so you do see these estimates of revenue impact. So here there's a number here for the US that was calculated based on basically the available data. But what is ultimately the impact is very hard to predict. And maybe one more thing before I stop, Wei. There's nowadays in the COVID context also a lot of discussion about one-off wealth levies. So this is not sort of a recurrent wealth tax every year, but this is basically to finance the cost of COVID. We need to have a one-off tax on the most wealthy in order to pay back the debt that we have created, which is an idea that has been suggested a very long time ago by many economists, and many economists actually favored this idea because it can be so efficient. What they said is, well, if you do it without any announcement, you do it just from day 1 to day 2, you say, sorry, all this wealth is now owned by the government. Then there's no opportunity for people to change their behavior, right? They're just caught by surprise. And if the government can also then say, well, we do it only now, we never do it again. Because if you do it again, people will, of course, change their behavior. They will never accumulate any assets anymore in your country because they are afraid of losing that. So you have to commit not to repeat it again. Then it's a non-distortionary tax. So that was the idea of some economists. Keynes was one of the economists that initially was in favor for this reason, but he changed his mind. And he changed his mind because he said, well, how can you basically do this? Because these two conditions are basically impossible to fulfill. You cannot really do it in an unanticipated manner. And if you have anticipation, then people change their behavior before the tax is imposed. If the discussions is going on, then people get rid of or make sure that they fall under some kind of threshold not to pay the tax. But if it is successful, then it's very hard for a government to commit never to do it again because it's been such a success. So you cannot credibly commit never to do it again. And then doing it basically signals a government that is not credible. So, and if the government is not credible, this hurts investment forever. So for these reasons, Keynes changed his mind, and I think we should also be very cautious in advocating this type of policies. We have some precedents from the past. After the World Wars, several countries have tried these one-off wealth taxes. And there's a very nice chapter in a book by Barry Eichengreen describing those experiences. And the experiences were very disappointing. There was one successful one-off wealth tax, which was in Japan, but that was under a foreign occupancy. So the foreign occupancy could be blamed for not being credible and not the Japanese government itself. And this was also one that was unanticipated. So that raised quite a bit of revenue, but that's the only example that he gave was under very specific circumstances successful. The others are basically have not been very successful. They are, however, at the table. They are being discussed. Argentina introduced a one-off wealth tax a couple of months ago. The UK is discussing it. They had this wealth tax commission basically advocating a wealth tax that would last for 5 years. So it is something that is in the mind of policymakers. If you want to discuss corporate income tax or consumption taxes, happy to do that during the discussion, but maybe it's good to open up, Wei.
I think we can with us.
I hear you well now.
Slowness. route. Are you ready to open the floor? Should we have some questions from audience members?
Yes,
Fantastic. Okay.
yes, please.
Yeah. Great. Thank you. So thanks very much for staying with us. And right now we can have the written questions and be called on. I think that I'm seeing it. Uh, uh, but feel free to submit questions or just indicate.
I don't know, Wei, I can't hear you. Are others having problems hearing Wei too?
Yeah, Ray is breaking up for me as well.
Okay.
Yeah, it's cutting out for me
Okay.
as well.
Let's see. I think I.
Cutting out.
Back.
Maybe I can jump in the absence of, I don't know whether you can hear me, Wei, but in the absence of others asking questions. Ruud, hi, it's been a long time since I've seen you.
Hey, David, yeah.
Thank you for the paper. It's like a great summary of everything you sort of want to know as you start to learn about tax policy. It's about everything. I have the 30-page version, not the 10-page note. So I don't know how you could get it down to 10 pages. But I guess what I want to ask you is sort of at a time like this, it seems to me like one wants to go for the low-hanging fruit first. And whether you've got a sense, I mean, I have a sense of in Canada where one would see the low hanging fruit. I think the capital gains tax inclusion rate, some of the exemptions from capital gains are probably low hanging fruit. A wealth tax is not low hanging fruit. That's a much more ambitious endeavor. And as you say, I think in principle, the idea of a one-time wealth tax is a great idea, given that some people have benefited from during the COVID situation, others have not. But in practice, it's probably extremely difficult. But I just wonder whether you could talk a little bit about low-hanging fruit.
Thanks, David. No, it's good to see you. I think it's very difficult to talk in general about what are the low-hanging fruits in countries. It is often very country-specific. And if you look at the US debates, I think it's obvious that in the capital gains tax, there's the issues of step up at death or the not realization at death and so on. These are sort of simple things to change that could raise quite a bit of revenue. But for other countries, it may be very different. I think what you do see is that in many countries, there are huge options in the value-added tax. But this is typically a tax that might not be the first on the minds of people when they think about sort of taxing in a more progressive manner. So we've seen that the response after the global financial crisis was primarily to increase VAT rates to recover the cost of the crisis. But I think this has also involved a lot of cost to countries who thought, well, we've seen the governments bail out the banks, and now the crisis is over. The people have to pay in the form of higher VAT rates. So I think governments are more reluctant to do these kind of things. So that's why I think the discussion is more focused now on progressiveness and sort of this whole idea of the inclusive growth. What we do see is that after shocks like this that are so unique and big, governments also think about one-off things, basically at add-ons to existing taxes. And thinking about a wealth tax, that would be require setting up a whole new tax, a whole new, in many countries raises legal issues. So it's not a simple low-hanging fruit, I would agree. But doing a surtax on the personal income tax where there is scope, I think is something that many countries can consider, or a surtax on the corporate income tax. And on that one, I would say, well, if we, the problem with the corporate tax is always that it causes so many distortions in terms of debt to equity, in terms of investments, international. But there are ways of doing it in a more simple, in a more efficient way by saying, well, we don't do the surcharge on the current corporate income tax base, but we change the base to an excess profits by saying, well, some return to assets is basically taken out of the base and only this excess profits becomes taxable. And that has quite some appeal also, because we do see that some firms during the pandemic do very well. Think of highly digitalized businesses, they make huge profits. So they make these excess profits. And I think there's quite a bit of appetite for getting revenue from sources like that, which shouldn't be too difficult. There are, of course, some other difficulties with profit shifting and so on, but I think an excess profit, and this has also some precedent in the past. After the World Wars, many countries had excess profits taxes that were quite successful in raising revenue. And it may even inspire us going forward in rethinking the design of the corporate income tax, which, as I said, has this inherent bias toward debt finance, which has caused many corporations to become more highly leveraged, more vulnerable, and every crisis this comes back to us, and then we think, well, why have we designed the tax system in such a way that companies have become more vulnerable for bankruptcy? So we regret it again and again, but it's time to maybe rethink those issues, and an excess profit tax would be an ideal candidate to sort of think about these issues and experiment with it. Sorry, I do not hear you, but if anyone maybe wants to raise a question, please go ahead.
Yeah, so I'll let Jeff speak up. Yeah.
Very great talk. My question, which I wrote in the chat, is wondering what your perspective on the future of information sharing is. Gabriel Zucman has advocated some kind of global wealth registry as a means to try to reduce the evasion elasticity of a wealth tax. I have no sense of what's actually feasible, and I feel like you might have a much better sense of that.
Thanks. You broke up, but I do see your question also in the chat. So, so it's about the wealth tax and whether information sharing across countries could potentially reduce sort of the responsiveness of reported wealth to the wealth tax, and if that's the case, whether there's more prospects for a wealth tax. I guess that's it's a very good point, but also a very important big unknown. How much sort of how well automatic exchange of information ultimately will work for various countries. I think there are high hopes, but also not much experience yet. There's some experience in terms of, there was one study done by a few colleagues of mine who looked at the impact of the introduction of automatic exchange for information on deposits held in certain low-tax jurisdictions. And we did see this huge shift after the introduction of automatic exchange of information in the amount of deposits held in these countries, which do point to significant shifts. But the question is, where was the shift towards? Was it to countries that did not have yet automatic exchange of information, or so there are also some unknowns still to be resolved. And there are many sort of design issues, which also Zucman and Saez discuss. One thing you mentioned here is the global asset registry, which is of course easier to put on paper to do that than actually implement. And if we see how difficult it is in developing countries to even register properties, I think for many countries this may be sort of a long shot, I guess. And more generally, there were also sort of discussions about, should we tax based on citizenship or residence? US taxes people on their citizenship. So wherever you live, you will always be taxed under a wealth tax, which is kind of a device that can also mitigate opportunities for evasion and avoidance. But other countries don't do that. So we can say, well, the other countries should also do that, so, which is sort of easier said than done again. So in terms of what is my expectation, I think these are really long-term issues, and we need a lot more to gain a lot more experience to convince people and countries that this is the right thing to do. But I think it is a promising area to see how much we can actually gain in terms of with the exchange of information, and how it can ultimately not only improve our current taxes and how we enforce those taxes, but also inspire us to think about new taxes, perhaps also wealth tax. So it's very interesting, but too early to say something meaningful, I guess.
So Ruth, there's a question in chat box asking about indexation for inflation in taxing capital gains. Does the IMF have a view about that? Do you routinely recommend inflation indexation?
To be honest, I don't know exactly how much we have advocated. It's not very common that countries have it. I think I listed 2 countries. I think Israel has it, and maybe one other country. So it's not something that's very common. And I think most countries try to do it through simpler means, just saying, well, okay, there is inflation, but well, inflation is not so high. I mean, maybe in the 1970s, early 80s, this was a big issue, but these days maybe it's not such a big issue, and let's just resolve it by having a slightly lower rate on capital gains or exempting part of capital gains. So which does signal that countries may find it difficult to implement real indexation for inflation. And I think the concern these days is not so much whether you should index for inflation, but much more whether the deferral is too big an advantage, rather than because the indexation for inflation basically reduces the base when it comes to the moment of realization. I think there's more concern that the capital gains are not taxed high enough, so that we should end somehow the deferral. Maybe by not taxing upon accrual, but by indexing for some kind of rate of return. So expanding the base basically of at the point of realization. And I think that's also, there are these equivalencies that you can think of an indexation scheme that you undo the gain from deferral. I think there's more appetite these days for such schemes than there is for sort of dealing with inflation. But that's my personal sense. I have not personally come across this question by a country, but it is quite rare, I guess.
Yeah. So Ruth, there's another good question in the chat box. Should developing countries be considering capital and wealth taxation at this point?
I think most developing countries also tax capital income. With respect to wealth taxation, it's less common because it's already so difficult for advanced economies. For developing countries, it's probably a bridge too far. Although I must say that Bolivia, I think last month, introduced a wealth tax. It's a very progressive wealth tax, so they target the top 150 people in the country. So they must have maybe some unit that follows and tracks the affairs of these 150 people or so. But I wonder how they can enforce it. So I think a wealth tax for many developing countries is probably not the first priority in terms of revenue mobilization. But capital income taxes, I think, should be part of the system for a number of reasons. And also, I think the main problem is with the capital gains. I think for dividends or interests, they should be able, I think, to enforce those through withholding taxes. And if you have a system like a dual income tax, with a final withholding tax on interest and dividends, you do get a significant portion from that. I think they should have a capital gains tax also as a sort of a device to mitigate avoidance. And also to make sure that if you have entrepreneurs who are organized as a closely held business, that you have a mechanism to mitigate avoidance between labor and capital income. So I think it's important, but it is often a challenge to properly administer. So designing it as simple as possible, which countries, many developing countries actually don't do. So many developing countries do have capital income taxes, but they have a multiple of specific exemptions or preferential regimes, which undermine the whole purpose of revenue mobilization through capital income taxes. And so there's a lot to gain, even in developing countries in that respect. But I think they definitely should have it as part of their system, and hopefully with time and also with sort of automatic exchange of information, hopefully that will ultimately also benefit them. I think that it's currently probably, even if they participate, hard for them to basically use all that information. Maybe information is not the problem, but it's the way they can deal with that information. But that capacity needs to be built up, and then I think it's an important part of the system.
Can I quickly ask you one question, if you can hear me? Yeah, you can hear me? Okay. So I find it hard. I find the concept of inclusivity very interesting. But the talk of progressivity, especially as advocated by some of these prominent public economists, seems to be picking out those small group of people who should be taxed more heavily. And that concept in progressivity, seems to me to be like some distance from the broader ethical concept of inclusivity. And so I wonder if you have thoughts about that.
Oh, that's a good one. Oh, sorry. That's a good one. I haven't really thought about that one, but it's of course, I mean, the discussion about the progressive wealth tax is very much sort of inspired by this idea that, well, having people that have so much wealth compared to others is not good for society for many reasons, and we have to sort of address that particular issue. So let's target that group through a specific instrument. So it's not so much inspired by sort of tax policy principles or what is a fair system, but it's much more sort of that we have institutions that have enabled some people to gain so much wealth, and how can we sort of repair that? But I think it's a much broader discussion. Ultimately, we should also rethink these mechanisms that allow in society people to earn that much money, right? It's also about regulation. It's about monopolies. It's about so it's a much wider discussion, I would say, than just the tax discussion, and it's. But
Okay.
so in that sense, I have not so much to say as a tax specialist about this particular.
Yeah. Because you can draw some analogy between this trend to increase progressivity and taxing the very few, and the practice that IMF recommends against, for example, raising the personal income tax exemption very high, right? And so in those countries, when the personal income tax exemption is more than 3 times average wage, they do succeed to tax only the rich. But that has not been the recommendation from tax specialists.
Yeah. No, I think that's a good point. That's indeed, some countries do that. They tax only the top, let's say 5% through the personal income tax. But what you see is that such countries, and also you see that in countries with a flat tax, they start to use other taxes to organize their redistribution. So they want to tweak certain parameters in the VAT, for instance, or have certain exemptions to advance the progressivity. But I think the personal income tax is a much better tool to do that. And some countries, especially if you have sort of emerging market economies with a growing middle class, I think these countries can gain a lot by having more people in the tax net, in the personal income tax. Very high thresholds for those countries should probably be reduced. Yeah.
Thank you so much. I'd like to see if there's a remaining questions. People want to take a last chance to ask any questions. Do any of the students want to speak up? Okay. In that case, thank you, Ruth, for your time. That was very interesting and very helpful. It's a lot to cover. There's such broad range of policy instruments to consider. And especially for those of us in law school, we teach the income tax and we tend to think about the personal income tax, the corporate income tax, and not much else. So this is very useful.
You were breaking up at the end, but thanks a lot, Lai, and much appreciated for the opportunity to discuss with you.
Yeah, please publish more papers. We will follow.
Very good, very good. I'll keep that in mind.
Okay, great. Thank you so much, everyone, for joining. You can find the paper on the IMF web.
Bye-bye.
Bye.
Bye, David. Good to see you. Yep.
Bye.